Hello traders, Gary Wagner here, just about 10 o'clock in Honolulu, 3 o'clock in New York, about 50 minutes left to go in the equities markets here on Tuesday, the 19th day of January 2016, and this is the daily report for gold and silver. With the markets relatively quiet due to a holiday here in the United States yesterday, we did open, but we're opening very softly today. Gold currently trading off about $1 on the day at 1088.26. The high is 94.59. The low is 82.67. And as I said, currently we are in essence unchanged to down $1 on the day. On today's video report, I want to present you an alternate Elliott wave count that was presented to me by a gentleman who is a highly regarded Elliott wave technician, and it's not his work either, but he thought it was so interesting in terms of the perspective on it that it was worth passing on to me, and I believe that it is worth passing on to you. So I want to take a look at that right now. So traders, the gold count that I want to work with you right now, as I said, is not my original work, and so it's a gentleman by the name of Deneric, and it's his gold count. Now, where it differs greatly from many of the Elliott wave technicians, including myself, is the fact that he has been labeling this top of the market as a major fifth wave, and that's something that I have tackled with and gone back and forth between myself, a gentleman by the name of Dave Bannister, for the last couple of years as to the major count, because that's one of the more difficult counts to come up with, because we're really going back and looking historically at the market. And we have tentatively, along with others, pegged this as a major third. However, Deneric is really looking at this as a major fifth wave, and that really changes the way we would operate our count, because rather than looking at this as a third and then this decline that we have just gone through as a major fourth wave, then we would go into a fifth wave. If this is correctly labeled as a fifth wave right in here, then genuinely what we're looking at is a fifth wave, a wave count down that would terminate the A wave. So you would get an ABC, of course, following a major fifth. So he's labeling this as a wave, and that's the wave that we have been embedded in really since 2010. Now, the way that he looks at it, this is our major count. Our intermediate count, as he sees it, is something like this: wave 1, wave 2, wave 3, which is really our ABC, and then he believes that we have a diagonal triangle count. So we've had two basic triangles in the market that are going to make up both waves 4 and 5 on our intermediate count, and that would be these two triangles right here. And so the way that that would all transpire is we've got waves 1, 2, 3. This would give us wave 4 right here, and that would take us into wave 5. Now, the count or sub count behind the intermediate on this last fifth wave here, meaning that we have 1, 2, 3, 4, and 5. That's our intermediate count, and that's in red. Now, if you look at blue, that's the sub count behind it, and the count would be something like 1, 2, 3, 4, and then 5. And so his belief on this count is that we will see a market move down to terminate on this fifth wave, and that would conclude not only the 5 of 5 sub count, 5 of 5 intermediate, but it would also conclude the A. And that's why it's such a fascinating count, because if that's the case, and the big and, if that is how this unfolds, we would then go into a B wave right here and culminate with the final C wave. It would be the C wave that would give us a low below these most recent lows at around 1,000. That would be the bear side of the coin, but on the bull side of the coin, we would be looking at a pretty effective rally, moving the market back up as we went into our B wave. Now, of course, that B wave wouldn't happen all at once. It would be broken into an intermediate and sub count also. But the fact that the possibility exists that we have some model out there that shows us we could be hitting some sort of a tentative bottom. That to me, traders, is really exciting as a gold bull, because I'd like to see a termination or an end to the type of pressure that we have gotten in this market. Now, let's make the really long stretch of an assumption that this actually pans out to be correct, and that is how it unfolds. Let's say that this wave actually terminates somewhere around $1,000 per ounce. I mean, we're trading at 1088, so we're not that far off of that. The interesting thing is that when you look at the basic model structure of your A wave to your B wave will tend to be anywhere between 50 and 75% that of your A. So if we saw our A move from 1900 to 1000, okay? So that's roughly 900. If we take a look at that and then we divide that to a 50%, that would take you to about 425, which would be about right here, to anywhere between that and 1450. Now, this again, these are very, very long-term studies. We're looking at a market on this study with a major that terminated back in 2010. So we're looking at an extremely long-term move in the market. But what that says is that if in fact the market does come out and it does bottom in this particular area, and we do terminate that A wave, what we're going to see is this market over the next year and a half kind of flutter back up, and that B wave, as I said, should take us anywhere between 50 and 75% that of A. I felt that this particular alternative wave count was interesting and has the potential to give us some real insight and information in the market, and that's why I presented it to you today. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.